Most investors have become enamored with selling covered calls to make consistent income, but few are aware of the deadly hidden mistakes that can make this a losing strategy. In this video, we cover the 5 fatal mistakes that you may be making without even knowing it, and we help you avoid all of them. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the #1 YouTube channel to help you grow your trading account.
Hi, I'm Seth Freudberg. I'm the head trader of SMB Capital's options trading desk here in Manhattan, and more investors are beginning to hear about an options strategy known as the covered call. And the strategy has gained attention lately because selling covered calls is a great way to enhance the returns of your investment portfolio through the strategic use of options. Given how bearish the market's been over the last few years, it's easy to understand why people are looking to improve their investment returns. And you can think of covered calls as a way of increasing the dividend income that you receive from stocks that you own, because the average dividend yield of stocks comprising, let's say, the S&P 500 is just 1.74%. And covered calls can increase that yield very, very dramatically. And of course, some stocks really, great stocks like Netflix and Amazon have no dividend at all, yet covered calls give you the opportunity to turn those non-dividend yielding stocks into cash flow machines for you also. But like any other trading strategy, there's a right way to execute it and a wrong way, and the difference between the two can be huge. And so while the covered call strategy is outstanding in many respects, there are pitfalls that you have to avoid if you want to successfully enhance the returns of your investment portfolio. And the purpose of this video is to share with you the 5 biggest mistakes that covered call traders make and the exact details of how to avoid them so that you can enjoy the upside of covered calls, which are considerable. I want to do a really super quick review of what covered calls are so that everyone watching the video is on the same page. If you already know how they work, just hang in there. This is going to be quick. A call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option at any time after the call buyer buys that call option. The call buyer pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call option's strike price, which is lower than they're worth. But it's also important to keep in mind that if at expiration you've sold a call and the market closes below the strike price of the call, then unless that call was previously exercised, the call expires worthless and the call seller just pockets the premium. So that's how call options work. Now, a covered call starts out with your owning 100 shares of a stock and then selling a call option on those shares that you own, usually at a strike price at or above the stock's current price at a fixed interval, like once a month or once a quarter. And so a covered call can have 2 possible outcomes. If the stock closes at any price below the strike price on the day the call option expires, the trader just pockets that call premium that he received initially. But if the stock closes above the strike price of the call option he sold, then his shares get sold for the strike price of the call he sold. And again, he pockets the premium that he originally collected for selling that call. So for example, let's say that the trader buys 100 shares of Amazon for $105 per share, laying out $10,500, as you can see from the calculation. But simultaneously, he sells a 110 call, expiring 1 month later for $3.50, collecting $350 in the process. Because remember, one call contract represents 100 shares of Amazon that must be sold at 110 at any time after the call is sold to the call buyer. So you multiply the 350 times 100, resulting in cash income to you, the cover called seller, in the amount of $350. And so there are two possible outcomes. In outcome one, the stock closes below the strike price of 110, and therefore the trader simply pockets the $350 he collected for the call, which incidentally is the equivalent of a 3.33% gain in 1 month. And remember, you can do this every month, of course, selling a new call expiring a month later and providing for potential large amounts of income into your account. Alternatively, if Amazon closed at 111, well, in that case, your broker would assign your 100 shares to the party you sold the call to, and that party will pay you $110 per share for those shares. So you'd make $5 per share on the sale of those shares. And remember, you also got paid that $350 for selling the call, and you get to keep that income regardless, resulting in an $850 gain on the transaction. And so what covered call traders like to do is essentially start a campaign of selling covered calls, just like the Amazon example, where they keep selling calls against the shares, let the calls expire, and collect that income each month. And if they sell them high enough and the shares never get assigned to the call buyer, you can see how the income would quickly add up, because that was just 3.33% in 1 month. And if you add that every month and the shares never get assigned, then the return could be in the 30s in that case. But of course, that would have to be if everything went perfectly, which of course it rarely does, right? Nothing goes perfectly all the time. So then you're thinking, well, this sounds great. I mean, what can go wrong? And that's what this video is about, because there are a number of ways that you can misuse and incorrectly trade covered calls that can result in problems. But they're easy problems to avoid, and that's what we want to get into in this video. Okay, so let's get into those easily avoidable mistakes. And the first mistake is so obvious that it almost goes without saying, but you'd be shocked how many traders fall for it. And that is the mistake of selling a covered call on a stock for which you are bearish. Now, why do I say that? Because the only risk of a covered call really is actually the stock's price going down. And why do I say that? Well, think about it. In outcome one that we discussed involving Amazon shares, you collected the 3.33% income in 1 month because Amazon closed at 109, so you continue to hold the shares, but you pocketed the premium. In outcome two, you were required to sell the shares, but at a $500 profit, and you pocketed the call premium for a total gain of $850. But now we're going to introduce outcome number three, and that's when the stock goes down. And in that example, yeah, you collect the $350 premium for the covered call, but the benefit of that is totally blown away by the loss you're going to take on the shares themselves. Like in this example where the stock dropped to 90, you still kept the $350, but you lost $1,500 in the shares themselves. And so for the glory of making the $350 on the covered call, you lost $1,150 in total because of the share loss. And so you can't just sell covered calls on any old stock. The covered call strategy is a neutral or bullish strategy. If you are bearish on the stock, it's just not worth it, as you can see in this example. And so I'm pleading with you to realize that a covered call is a neutral or bullish strategy. I say neutral because if the stock just flatlines, then you'll make the call premium, which on its own can be really attractive. And if the shares go up and they are assigned, then you win two ways. You make the profit on the shares and you make profit on the call premium. But if you're bearish on the stock, then it's not worth it. You have no business being in a covered call if you can lose all that you made on the call premium and more by the stock going down. Now, of course, there's always that risk on a stock that you're neutral or bullish on, that of course it could go down and you could be wrong. But if you're expecting this stock to go down, then a covered call is a really, really foolish strategy to use. Okay, so now let's move on to covered call mistake number two, which again should be obvious, but when you think about it, you'd be surprised how many traders fall into this trap. And that is to stay in a covered call trade once you've turned bearish on the stock. You see, what happens to people is that they undertake a covered call campaign every month and they get sort of addicted to that income that they're making each month, which in the Amazon case was $350 a month every month, theoretically. And they start relying on that income in some way or another, but they lose sight of the big picture, which we just showed you before, which is simply that the stock selling off is the risk of covered calls. And when you yourself are predicting the stock will go down, in other words, when you've turned bearish on the stock, you must end the campaign for that stock, close the trade, and look for stocks where you have either a clear neutral or bullish stance, which you can then roll your capital into and execute the strategy as to that stock. And so it's critical not to become addicted to the covered call premium you'll be receiving each month. You started out bullish on the stock. Okay, fine. Otherwise, you never would have entered the trade, as we discussed earlier. But once you turn bearish, you've got to have the discipline to exit the trade and avoid turning a winning campaign into a losing campaign, because your common sense obviously should tell you to get out and pocket your winnings. So get into the habit of asking yourself at least once a month, when it's time to sell the new call against the stock, am I still bullish or at least neutral on the stock? That one discipline is going to be invaluable to you long term, because you will be letting your winners run and cutting your losses short, like any good trader or investor will do. Okay, so now the next really massive mistake that covered call traders make is to sell a call on a stock that they are super bullish on at a strike price which is far below their profit target for the stock. This mistake often happens because the trader looks at how much premium he could get for a call he can sell in that next month and get mesmerized by that call premium, forgetting that there's a much more profitable potential in the trade by just holding the shares. So let's look at a vivid example of this. Suppose you were super bullish on CMG back on July 1st of 2021 when it was trading at about 1538. Well, if you were to buy 100 shares of CMG and then sell a call just slightly above the stock price a month out on July 30th, let's say at the 1550 strike, you would have collected a very healthy premium, $47.06. Now, as you can see from the calculation, you bring in $4,706 because you're getting $47.06 for each of the 100 shares that call represents. Okay, so now let's move forward to July 30th. And as you can see, our super bullishness was accurate. And that CMG stock did indeed make a big push upwards, closing at 1863.44 on July 30th, the day our options expired. So we were right about the bullishness part, obviously, right? But there's a problem. And that is that we sold that call, and that turned out to be the worst thing we could have done. You see, our profit from selling the 1550 call against the CMG shares is calculated by subtracting from the strike price of the call the price we bought the shares for initially, which, as you can see from the calculation, comes to $1,260 because we were forced to sell the shares at 1550, even though they were trading at over 1863, because we sold that call at 1550. So the only profit from the shares was the difference between what we paid for them and the strike price of the call. And yeah, the call premium was what options traders call juicy, and we received $4,706 for those calls. And so our total profit was $5,966. Whereas if we had just bought the shares that we were super bullish on and just held those shares until the end of the month, we would have made $32,604. So in other words, the call cut our gain down to $5,966, leaving $26,638 on the table. And so the solution's simple. If you're super bullish on a stock, don't sell a covered call on it. If you do that, you run the risk of cutting your profits way short on a stock that you predicted would rally, and it did rally. But you gave up most of the upside by trying to make the relatively minor income coming from the covered call. It just makes no sense if you're super bullish on a stock. Okay, now, the fourth huge mistake is a little nuanced but extremely important. You see, there are occasions where you're bullish on a stock, but the stock sells off. Yet you maintain your bullish outlook on a stock. That could be legitimate. It may have just temporarily sold off, but you're still bullish. That absolutely can and will happen in any covered call program. And so if the stock price goes down and the call you sold, say 30 days out, expires worthless, then it will be time for you to sell a new call another 30 days out. That's how a covered call campaign works. Well, at that point, you've got to choose a location for that new strike price. And that's the danger point where you can make the mistake of selling your call at a strike price below where you originally bought the shares. Let's show you an example of how this can happen. So let's take a look at Tesla, for example, back in December of last year. And as you can see, it closed at 194.70 on December 1st. And so suppose we became bullish on Tesla and we bought 100 shares of it that day with the intention of starting a campaign of selling covered calls on our Tesla shares. So we pulled up an options chain that expired on December 30th, about a month out, and we sold the 200 strike call expiring in about 30 days for a premium of $10.12. Now, let's take a look at the cash flow of that transaction. As you can see, the cost of the Tesla shares minus the premium we brought in from selling the call netted our initial cost down to $18,458. Now, let's move forward to the day that the call option expires on December 30th. And as you can see, Tesla went down in a big way, down to 123.18. And so that 200 call expires with no value, and we get just pocket that $1,012 that we collected for selling it. Now, at this point, we need to refresh the campaign, and so we go out about another month to the 130 call, slightly above the current price of 123.18, and sell that for a price of $9.02. And so updating the cash flow chart, you can see that the cash flow from the new call has reduced the overall cost of the campaign a bit. And now here's where it gets interesting. So let's move now to the day the January 130 option expires. And as you can see, Tesla end up bouncing by the end of the month, closing at 177.90 on the day that the January options expired, which means that the shares were automatically assigned to the buyer of the call you sold, and thus your account will reflect that your Tesla shares are gone and that you've been paid $130 per share for those, which is what happens, of course, when a 130 call gets assigned. And so the trade has, at least for now, ended because there are no shares to sell those calls against. And so let's calculate the result of the trade. And as you can see, we start with how much we were just paid for those shares, $130 per share, and we add to it the income we received from selling both the December and January calls we sold. Then, of course, we've got to subtract out the original cost of the shares, which was much higher than we just got paid for those after they were assigned, which results in a loss of $4,556 on a campaign that was intended to pay us monthly income as a kind of bonus for owning those Tesla shares. But instead, the whole thing ended up blowing up in our face because the 130 calls forced us to lock what was an unrealized loss and turn it into a realized loss. And so what's the solution to this terrible outcome? Well, first off, if you're wrong and the stock goes down, instead of selling a call slightly above the new lower price, you sell calls at the lowest. The lowest you would sell the calls is at your original share acquisition price. So if the stock does rally, you'll end up at least breaking even on the shares and making good money on the calls you sold, hopefully. Now, you may find in some cases if the stock has dropped enough that the call at that level just has a price that's so low it's not worth it to sell the call for that month. And at that point, you've got two choices. You can either just wait until the stock bounces enough to sell a call a month out that has a decent price for you to fetch when you sell that call, or you can go out maybe 2 or 3 months where the premium will be higher at your original share acquisition price, in which case it could be more reasonable to sell a call at that price and the call selling campaign can resume. Regardless, you absolutely must not sell the call that would lock in an unrealized loss, turning it into a realized loss like you saw in this example. Okay, so now the fifth and final deadly mistake you can make as a covered call writer, and that is to take a stock that you've owned for a long time and it has a huge embedded unrealized capital gain in it, and you figure, hey, I'll get some extra income out of this stock by selling covered calls on this stock. So let's say that for the sake of argument that a trader had bought 100 shares of CMG stock back in April of 2008, 15 years ago, when the stock was trading at $100 per share. In other words, an investment of $10,000. Well, CMG is now trading at $1,728 per share. Those shares are therefore worth $172,800, meaning that he has an unrealized capital gain of $162,800, as you can see from the calculation. And so let's say that he went ahead and decided to get some income out of those shares by selling a covered call against them, say 5% above the current stock price, which is at approximately $1,800. Well, those 1,800 calls about a month out are going for $36, which, as you can see, would have brought in cash flow of $3,600. Now, if the stock were to close above $1,800 on the day those options expired, his broker would have automatically assigned them to the guy who bought those calls, and he would have received $180,000 in cash in his account. Subtracting out his ridiculous original cost of $10,000, he would have gone from an unrealized gain to a realized gain of $170,000, as you can see from the calculation. Assuming he's at the highest long-term capital gains tax bracket in the U.S., that tax would have cost him $30,000, even though his cash flow from the options premium was only $3,600. I'd say most people wouldn't think that was really worth it, and had they thought it through from the beginning, they never would have sold a covered call against that stock. And so what I'd like you to take away from today's video is that the covered call is an excellent strategy for enhancing the returns on your equity portfolio if you avoid the pitfalls outlined in this video. Any of these mistakes can negate the value of a carefully designed covered call program and make the whole exercise something you'll actually regret. Otherwise, used intelligently, the covered call is a perfectly valid approach to enhancing the long-term returns on your portfolio and is a great option strategy.
Okay, it's one thing to learn how to avoid costly mistakes, but it's another to know how to earn much more from your trading and investing. Click on the video appearing on your screen right now to learn how to triple your options income with an easy to learn strategy.